All right, I'd like to welcome everybody to the February 21st, 2024 Town Hall. It seems like these 2 weeks get closer and closer together every time that we do this. It's just they come in very quickly, but we do have a lot of fun doing it. I'm going to talk about some of the things that are going on in the market and a little bit later. Again, I had up on the screen for those that saw it, the upcoming events that we have. They are events that you can invite somebody to or come as yourself. So which they're those easy way to introduce us to people like you because you are the people that we enjoy doing business with. So those are some of the events. I'll talk about those later on in my part of the presentation, but I'm going to go ahead and turn the first part of this presentation over to Mel.
Thank you. Um, what I'm going to really kind of delve into a little bit, I looked at a lot of different articles about this subject, but it's something that has come up a lot, and we're used to dealing with it on a pretty regular basis of the transition from preparing for retirement, being retired, the first 2 or 3 years in retirement, and then on through that. It can be a pretty stressful time, but the 5 stages of retirement are pre-retirement, where it's nice to dream about what retirement is going to be, and we're looking forward to it. And I can't wait to not have to do this job anymore, or I have all these wonderful things I want to do. To okay, now I'm retired, and we go through the honeymoon phase. The honeymoon phase can last 1 to 2 years typically, but can be longer for some people. And that is okay. Now I can do all the things that I thought about, and that tends to lead into unhappiness or disappointment or a static situation, because people find out that the fun things they wanted to do don't fulfill all of their needs or purpose, and things can happen where they're just not really satisfied with what's going on. Now that phase can go for a while, and the fourth phase is to reestablish or find yourself, or find out what it is that you enjoy or want to do that can occupy yourself and give you a purpose. Because without the purpose, a lot of us just really get sedentary and just don't get anything done, or we're not happy with where things are. And then the final phase is stability. We deal with the first 2 or 3 phases more than anything else, because once people get into that, I've gotten to my purpose again, and I'm stabilized. They're okay. It's just a matter now of making sure that the money's taken care of. But pre-planning for the retirement is usually between that 10 to 5 year range. And one of the things that Steve talks about on the radio occasionally is people say, well, when I'm ready to retire, I'll come see you. You've skipped the first phase. You really need to know a lot more, because we run into a lot of situations. We've had clients come in and didn't realize that Medicare was not free, that had no idea they were going to be taxed so heavily on their Social Security, that converting from IRAs to Roths means you have to pay the taxes up front and in large chunks if you want to make it worthwhile. Or that inflation makes things more expensive on a pretty regular basis. Well, gee whiz, I'm making this much money. I've got my Social Security, my pension. I'll be fine. Right up until we get the first 3, 4, 5, 6, 7, 8% inflationary year, and it really drives home that there might be a need to make sure that you can stress test your retirement. I'm talking about the stress of the person going from the retirement mode to the honeymoon mode to the settling in. And Steve and I deal with that on a very regular basis in helping people get to that transition. It's a really big deal when you've been budgeting all your life and you live off that budget, and the income comes in, and I got to save, I got to do this, I got to piece my dollars together so I can do that thing I want to do, or buy that thing I want to do, or go where I want to go. To all of a sudden, I don't have a job, I don't have a paycheck, I've got Social Security and maybe a pension. And for the majority of our clients, that's not sufficient to support the lifestyle they wanted to live in retirement. So there's a gap. And the stress comes of I only have this much money, but it costs that much. How do I fill the gap the way I always did, by budgeting and making sure that I save for that particular eventuality, where now I have to reach in and spend my money, but I've spent my whole life avoiding spending that money as much as possible. So there's a real psychological hurdle going from living on a paycheck to creating the paycheck out of your own assets. And it can be a pretty big thing to occur, and it is kind of fun when we have clients like that. I've dealt with a couple of this week that are making that transition to, how do I do this, to, oh, it's okay to spend some of that money. And in fact, that's what I saved it for, was to be able to have those funds to provide for my retirement, and making that mental and psychological hurdle to, I can't spend it, to yes, I can, is a really big deal. Now you can go too far the other way, where, okay, it's the honeymoon phase and let's go this, let's do that, let's do this. We spend more. Sometimes you can overdo it in that way. So that can lead to stress. Finding the happy medium to, it's okay to spend the appropriate amount of money, is something that we help people do on a regular basis. So that's stress testing, or stressing, excuse me, that is trying to handle the stress for yourself of you making that psychological transition to being retired. The other thing that we try to help people do when that pre-retirement is stress test your retirement concepts. We do that sometimes. We have a one that we do here occasionally. We call it the peanut butter jar test, where when we do all the analysis and we have different software packages and we lay it all out and said, okay, you're going to be fine. You have more than enough money and income to take care of your lifestyle and for the rest of your life, but people are still stressed about, will I have enough money? Then we perform the peanut butter jar test. And what that is we pretend to take all of your money and put it in peanut butter jars and bury it in the backyard. And it never, ever makes another nickel for the rest of your life. And then we apply a zero rate of return to the software packages. We still keep your income where it was. We still keep up with inflation, and we can change rates of return to zero. And if you still going to make it to 95 or longer, making absolutely no income or growth whatsoever, guess what? You probably have a pretty stress-free retirement. But if we run it at a 2% return and it still works, then that's okay too. But if we run it at what you asked for and it doesn't make it, if there's higher inflation or if there's a lower return, then maybe we have to make some considerations about the viability of that planning. So I know I threw a lot of numbers and concepts out there, but let me just kind of cap it this way. When we sit down and plan out the next 20 or 30 years of your life financially, and we're looking at different scenarios, some of those we apply very low rates of return, very high rates of inflation. We can throw in a nursing home stay digitally with the software. We can make one of you the survivor of the other. So we can put these different scenarios together to see if these things were to occur. Does the plan work? Does it work with minimal returns, or does it work with high returns? Of course it would, more likely to. Or do I keep running up against failure points at an age that might make me uncomfortable? So understanding what the odds are under varying conditions can really help relieve your stress. And also we can stress test the retirement funds itself to make sure that we have it going and coming, that you're going to be okay. Those are very, very positive things that can, again, help you maybe eliminate some of the stress on the cash flow problems when you get into retirement. Feel free, if you haven't had that done or you want to do that, if you're a client and you want to do a stress test on your current planning, the way that we have set up for you, we're more than happy to do that. If you're listening to this and you're not a client, then we would be more than happy to run that analysis for you. All you got to do is give us a call. That's fine.
All righty. Thank you very much, Mel. I'm going to go on a little bit different track today. I'll cover quite a bit of the things that I wanted to cover, but I did get a couple calls from people, and I enjoy getting that. Calls from you, the clients, on the concerns that you have. And one of them was around the ideas that one, what I call unfair comparisons. Steve, the S&P 500 and the NASDAQ were up double digits last year. Why was my portfolio not in that condition? And I'm saying one of the things that we need to be careful is when we start comparing things. We work with well-diversified portfolios, so all of our eggs are not in one basket. The S&P 500 is 500 large cap stocks, predominantly being driven by a lot of people have heard of the Magnificent Seven. There's 7 stocks that are highly driving that S&P 500. They also looked at the NASDAQ. The NASDAQ is 100 stocks, predominantly technology stocks, being heavily driven by 4 to 5 different stocks. And the way I look at it is, if I'm in a 60-40 portfolio and I only have 60% of my money in equities and 40 of it in fixed income, how can I compare that to an all large cap stock fund? So let's be careful with the comparison times. The other thing that I like to say is be careful with the time frame that's chosen. Because when I looked at a lot of people, that's to sit here and say, how much was the S&P 500 down the year before? Well, I'm not sure. I'm just looking at what it was up this year. Well, remember, a lot of our clients, we moved money away from the fixed income portion of their portfolios in 2021. Why? Inflation's at an all-time high. Interest rates are at all-time lows. And then all of a sudden we look and say the government's going to start raising interest rates. What happens to fixed income values when interest rates rise? It's like the teeter-totter. When interest rates rise, the value of those bonds fall. Now, if you hold them to maturity, you'll still get the maturity balance, but your portfolio will look smaller. And that's what people are talking about. So we moved a lot of those funds into a fixed indexed annuity that cannot go down due to market volatility, nor could it go down if interest rates rose. Now we're talking a lot of those things are getting to be 3 years old. They're still fairly flat. Why? Remember, 2021 was the top of the market. These new highs that they're talking about are from 2021. So during that time frame, the markets have done almost little to nothing, with the exception of a few. Large declines in one year, large decline ups in another year, and then kind of flat. So let's look at those. We got to be careful of one, the time frame that we're looking for comparison when we're comparing investments, and two, am I comparing apples and oranges, or am I comparing apples to apples? So those are the things that we look at. The other question that was brought to me, Steve, the target models have a little bit more of not fully invested. I've heard that, 65 to 70% of the companies have beat their estimates. Why are they being cautiously optimistic? And I think that's an absolutely wonderful word, because we look at it right now. As I just got done saying, 21 to 23, the markets have been fairly flat. There's not been a big increase. If you took those 2 points, if you played Rumpelstiltskin, fell asleep and woke back up, you go, wow, nothing's happened in the market. It has been up and it has been down. And I believe that the models are cautiously optimistic. I like the fact that Brad does give us, for our clients, the market update, that you can actually watch and listen to the gentleman that's managing your money talk about what's going on out there. But we'll look at it. Why are we cautiously optimistic? One, everybody thought the Federal Reserve was going to just start dropping interest rates, because usually when they drop fairly quick. And they thought it was going to happen in March. And now they've decided it's not going to happen. There's talk from some of the Fed officials that they could still see an interest increase at this time. So we've got a Federal Reserve that we're really not sure of the direction in which they're going to go. So I think cautiously optimistic is a pretty good thing. Russia and the Ukraine. That's been going on for a while. Hasn't affected the market, but if it spreads, it could. Then we have to look at Israel and Hamas. If that spreads to the rest of the Middle East, then we could have some things that go on there. And I'm sure nobody knows that we got a presidential election coming up in the next 5 to 8 months because of the fact that's going to cause a problem. Now, presidential elections in the long run, unless one side of the aisle wins both the presidential, both sides of the House and Senate, usually markets are a little upward. One party slightly higher than the other one. But usually within 60 days of an election, most of the volatility is, quote, out of the market. Why? In today's environment, 50% of the people are going to be happy the day after that election or the day after they decide who won that election. And 50% of the people are going to be upset. We don't have this big 70-30 split or anything like that going on in the US right now. It's close to that 50-50. So those are the words that I look at. Federal Reserve, Russia and the Ukraine, Israel, and the election. I think it's a good time to be cautiously optimistic. I don't think it's a good time to be sitting in cash, but I think it's a good time to be sitting cautiously optimistic. The other thing that I will talk about, this is geared more towards clients. The idea that we just found out today that we have 2 structured notes by Morgan Stanley that were bought back. So a lot of our clients hold that note. So they have that 6 months they could buy it back. Well, they have done that. They've redeemed it at full. And now we have to look at how we are going to reinvest those dollars. I'm looking at it for a lot of the clients, those that are under $10,000 in the notes, that we might just look at moving it back into AUM. For those that have more than that, I want to talk about the yield notes. Those yields have come down. That's why they're being bought back. And then I would like to talk to you about a dual directional note. These are things that we think have the opportunity that are not directly with the market. So those are things that you could call. If you're one of those people, please call the office, set up a time. I don't need an hour and a half to talk to you about structured notes. Myself or Mel can talk to you about that. If you're not a client and you're sitting out there and saying, how do I protect my assets and not use an annuity to do it? Give us a call. Sit down. Let's talk about how notes that have been around for a very, very, very long time can be used in a portfolio to help protect your assets. So again, let's look at it. Cautiously optimistic is a great way. Clients, if you look on your statement and a note's been called, we'll get a hold of you. But if you want to get a hold of me, that could probably be the fastest way to do it, because I got a lot of people to call. The other thing that I do want to share again is that screen on the things that we're actually doing for our clients. Cooking class. We had one of those last night, and I can't eat as much as I used to, but we did an Italian dinner last night. It was absolutely fantastic. Homemade pastas. It was fun. Then we look at Mel's going to be doing a presentation tomorrow night, Thursday, Tuesday of next week. Twisted Tree, Sunset Hills, annuities, the good, bad, and the truth. And Mel might sprinkle in a little bit of that. What do you do if you don't use an annuity? The open house with Mr. Jim Donovan. Jim Donovan's been my accountant since about 1984, 85, and he has done my taxes since then. So we're going to have Jim come up in the presentation room and talk to everybody about taxes. Cooper's Hawk, March the 5th and the 7th. Again, we're going to come back with annuities at that time. Mel will be doing that presentation. And then we look on March the 13th. One of the questions we get asked almost all the time, when should I take my Social Security? So we're going to talk about that here in the office on March the 13th. So please look at these dates. If you've got questions about these things, please don't hesitate to give the office a call. If you know somebody that's got questions about these things, please pass this on to them and tell them they can come. All they have to do is reserve their seat. They have to reserve the seat. They can't show up without giving us a call. So give us a call at the office. It's been a fantastic year. I can't believe we're sneaking up on the end of February already. You know, it's flying by, and we're growing here at the All Financial Group. You know, and it's because of people referring family and friends. And I just want to thank everybody out there for being a part of our family.